Hello and welcome. Today I'm going to show you how to solve the big case from the first round of the Financial Modeling World Cup 2025. It's called Advanced Fabricating Machinery, AFM Enterprises by Andrew Grigolyunovich. And I thought I was going to have to do a do-over for this video because I kind of made a mess of it in my live solve. And then I realized actually most of the solve up until the end and up until I spent half an hour in debugging hell was actually fine. So what I'm going to do instead is I'm going to show you my live solve, and then I'm going to kind of cut back to the couple of minutes right at the end where I figured out what was wrong and fixed it, and just bolt that part on. And then I think I've got a pretty passable solve. So um, compared to my normal, if you've seen any of my solutions from like the past couple of years where I was always frantically sprinting, I made a very conscious choice on this one to try to go slower, because the sort of incentive system has changed. So basically, it's not for the last couple of years, winning the tournament was mostly a function of being able to achieve the biggest time bonuses, and now there's minimal time bonus beyond saving 10 minutes, and so I'm trying to get sort of unwind some of the bad competitive habits I made about, hard coding values and doing everything terribly, which should hopefully, I mean, it'll make me slower, but it'll also hopefully make this video vaguely more educational. These three statement model questions are effectively like 8 standalone questions, like model a debt facility, model an asset schedule, etc. So if you're watching, I would say watch the first few minutes for the setup, and then watch whatever other schedules you're interested in. Or if you want a puzzle, watch the whole thing and try to spot the moment, because there is just one single moment where everything goes horribly wrong before I come back and reveal it at the end. All right, here comes the live solve. Okay, so we've got a few years of historicals, all three statements, interesting. And so presumably we're going to be making an annual model. Let's have a look. I think I'm going to read it on the screen, but I'm going to use this drawing tool to mark things off. So typical financial modeling exercise, three-way, yada, yada, yada. Fine. I've been hired to create a three-way financial blah, 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 blah. Retail, corporate, and industrial customers. Okay. Only serve the domestic market. Sales volumes in the domestic market are expected to grow slowly, except in the retail segment is moving fine. Financial model, 5-year annual financial model. Okay, fine. So I'm just going to go ahead and assume these are yes. Okay, fine. So we'll say E month this 12, 2, 3, 4, 5. Hide all the rest. So let's yes, 5 years, good. 2 parts. Part 1 deals only with the base case scenarios and will guide you through creating a three-way financial model. Okay, so we've got scenarios, circular references, and a revolving line of credit coming up. Oh yeah, and I do want to check right from the start what the last couple of questions look like. Oh yeah, so they're both. Oh, that's terrible. Fine. Closing cash balance and revolver. Ugh, that's unfortunate. Growth, best, base. Okay, fine. So let's see what our scenarios look like here. I'm not seeing scenarios here. Okay. I guess we'll come to that. Part 2 of the case will require you to add an option to switch between 3 scenarios, as well as introduce the revolving line of credit, which will require you to put a circular reference. Okay, fine. So let's just go ahead and turn those on right now, if they're not already, which they sometimes are in a file like this. Yes, they're already on. Good. Okay. Sales. Domestic sales were as high as 3 billion in Neverland dollars. Yes, they were. The exact split between the segment, the volume data in millions, as well as the unit sales price per segment are provided to you in the financial model. Unit sales will grow every year from 5 to 15% depending on the segment. The average unit sales price will grow from 5% depending on the segment. And then we've got scenario adjustment. Please tell me these scenario adjustments are actually put in here. I would hate if we had to type all this nonsense. Subordinated debt, tax, dividend. Stock, working capital, fixed sales growth. Okay, here we are. Retail, corporate, industrial. Okay. So when he says between 5 and 15, it means that. Fine. Volume capacity constraint, 1,000 or a billion, I guess. Fine. So let's just check. It's sold times that price. Is this going to total back to 3089? Yes, good. Okay, so I'm just going to add in schedules because I find it easier to have that in a separate tab. So start with revenue with an extra E just for fun. And let's do this. So then for 2024, we've got retail, corporate, industrial. So I want, I'll put it there. So units, price. Okay, so that's my 2024 numbers. Okay, and then these are going to grow at separate rates. So retail, corporate, industrial, hopefully they're always listed in the same order. They are. Volume growth, fine. So it's going to be this times 1 plus this block out. And price growth, this times 1 plus this block. Copy out. Okay. So then revenue. And we'll add a total. Okay. It's really, it disagrees on 1 decimal point. That's not ideal, but fine. Okay. Sorry, I want to mark off the assumptions as I'm using them. So, now where's my volume constraint going to come in? Yeah, that is going to come in the last couple of years. So let's find out what's going on there. Growth scenario, unit sales will grow 3 points faster in each category. 3 points slower in each category. This is annoying. Okay, so let's do base scenario. So what are we saying? Growth is 3% faster unit sales. Volume. Volume growth is +3. Worst is -3. I don't know why you would ever not have these assumptions somewhere in the model, unless I'm missing the no. Why would you ever have to type it in? It makes no sense. But anyway. H with a J, not an H. So it's growth, worst. Okay, and just base 0. And then I'm going to want active scenario. Should be one of these. Start with base. So, sorry, I want to call this active sen. Then we're going to XLOOKUP actsen in here, returning from here. Okay. So then the volume growth is going to be this plus that. And then same thing for price. Okay, so the growth scenario is 1% point faster and 1% point slower. Fine. Happy days. Okay, so then just quick check. If I say growth, it'll go up. If I say worst, go down. Happy days. All right, so let's read about this capacity constraint. Sorry. These are done. These are done. Fine. Only able to produce and sell 1 billion units. Not a problem. 24, yada yada. Case the maximum capacity is reached, first satisfy the demand for their industrial clients, then corporate clients, and then retail. Chances are the retail unit sales will be lower than in 24. Fine. But then, I guess, it's not obvious. Yeah, well, I guess it doesn't matter. Okay. All right, so first of all, let's get rid of the hash because we're going to model these separately. Whoops, sorry. And get rid of the dollar and get rid of that. And just see that was, yeah, let's do point to that range. We'll do the same. Okay. Wait, what the? Right, that's misbehaving, but that's fine. Copy that across. Whoa, what the hell? Oh, all right, I accidentally triggered a robot command. All right, so now we're back to getting over here. That's what I wanted. Fine. So then, what's the order of priority? First industrial, then corporate. Okay, so industrial will just always be what it is. Then this will be the min of that calculation and the capacity constraint lock minus the industrial. Which makes no difference. No. Oh, sorry. No, what? Oops. Oh, sorry. Moved on to a new line. Okay, so no difference here, no difference here, no difference here. Okay, never makes a difference. Fine. And then this will be the min of all of that and the capacity constraint lock minus the sum of the other two. So then we hit exactly 1000 and exactly 1000. And now my question is just, is there any scenario where this is going to go to 0? And the answer is yes, but it never goes negative. That's what I was really worried about. Worst. Fine. Okay, back to base. All right. So now we'll link in our revenues, and actually what I should have, oh, hang on, whoa, that's a lot lower. Right, it's because you're still multiplying with the hash, which is not what we want anymore. Okay, that looks better. Do feel like I'm going slow, but my directive to myself was to try to go slow, so I try to allow that for now. Copy formulas across, formulas across, formulas across, formulas across. The setup that I like to have is just carry everything on the balance sheet over until such time as we say otherwise, and then we can make sure that our balance sheet remains in balance. Just going to wrap this in around to, let's say, 6 decimal places, carry over. Then I want some square of that. And then I want to have some conditional formatting to say light up like a Christmas tree in a very alarming way if my balance sheet is not balancing. That will help to remind me to put in all of the bits of the balance sheet at the same time. So then if I were to delete that, for example, yeah, it all lights up. Good. Okay, so cash flow statement. Add back depreciation. We can just point that to the depreciation line, wherever that is. Oh, hang on, what? Oh, sorry. There's net income. Okay, sorry. So yeah, here, let's do it this way. We'll do 226. I want to make sure that that stays the same. Then add back depreciation. This. Copy that across. Add back amortization. Minus this. Copy that across. Add back deferred income taxes. Yes. Okay, we've got current and deferred split out, so that's helpful. And changes in net working capital, so that's going to be, we should be able to do this. So 11.2 is the number to match. So it's accounts receivable, previous period minus current period, plus same thing for inventory, previous minus current, plus same thing for prepaid, previous minus current, plus accounts payable, that minus that, and I'm going to put tax payable in there. No, I think not, because we're getting the deferred income taxes. I'm not totally confident of that, actually. Oh, hang on. That only got you to 8.2 instead of 11.2, so that might answer my question about yes, we are going to include. Thought the tax might be covered elsewhere, but I'm mixing myself up. Okay. Okie doke. Capex, PP&E. No, that's not directly linking from anywhere up here. I'll come back to it. That. Net cash flow, opening cash is already linked, good. Net cash flow, closing cash, okay. And then we're going to have our retained earnings. Just add our net income. Scroll up. Thank you. Our net income. I'll have to adjust for dividends in a minute, but and then if we link our cash, that should all for now tie out. Yes, happy days. Okay. That's working. That's at least semi-working. We'll need to adjust for dividends later, and that'll do for now. Okay. Slowly, but okay. So, fine. So that's done. Costs. Direct costs, fixed indirect costs in 24 were that. Assume all costs will rise by 3% every year. 2%, 4%, fine. So where is my cost inflation? Okay. Just going to put it over here. Growth based active. So growth scenario. Where are we? No, growth is 2%. Worst is 4%. Base is 3%. And active is X lookup accent in here. In here, returning from here. Okay. And then we'll just link this. No, wait, is it this one? Yes, this one. To here. And we'll mark that as a used assumption. So costs are given in 24 number is fine. So cost index. That starts off as 1, and then this times 1 plus this lock. Lock. Thank you. Okay. So unit cost fixed. Why is it not scrolling for me? Come on. Very annoying. Materials, labor, energy. Okay, fine. Should bring the labels from here. Okay, so let's do this times this whole thing here. That's good. So then variable cost of materials, labor, energy is fine. So just do $1,000,000. Sorry, I call it MM here for some reason. This is going to be this times number of units produced. Hopefully that's 1702 matches what's up here. It does not match that at all. Oh yeah, sorry, because I also have the other thing. So when I add that in, 1903.8, yes, good, happy days. All right. So then my COGS is just going to be the sum of all of these. Okay. There has to be minus. Okay. All right, it's probably a good time to answer some questions, make sure I'm actually going somewhere. What were revenues from sales to corporate clients in 24? Revenue corporate 24, 853.9. Projected unit sales price for industrials clients 25. Industrial 3.56. Oh, more decimal places, please. 3.5638. Total projected sales revenues in 25. 3458.9. 8.3. Yes, 1, 2, 3, 4, 5. Yes. Total projected sales over the 5 years 2643.8. Good. Projected labor cost per unit in 25. That's this, and probably more decimal places, yes. 1.1227, good. Projected variable cost per unit in 29. 2.4693. 4693, yes. Total projected COGS over the 5 years. This is what I meant about the signposting questions are very helpful. 12.2628. 12.2628, good. Okay. Then EBITDA, I don't think we're ready for that yet. No, we need to do SG&A, and then we can do EBITDA. Okay. So let's read about SG&A. Oh, sorry, SG&A will just rise by 3% every year. Right. So SG&A. Actually, I don't even. Yeah, it's fine. Let's just do it. For some reason, the opposite sign over here, but never mind. Yeah, I don't care about sign consistency here because it's just a supporting schedule. So EBITDA over the 5 years, 5787.9. 57, yes, good. Okay. All right, on to the next thing. So that's all of that. Let's talk about working capital. Man, still have pages of this to go, and I'm 20 minutes in. I think that's actually okay. For all the components of working capital, use fixed assumptions for the 5-year period. 45 days. Okay, so hang on. Where are my days assumptions? Okay. So accounts receivable, 45 days of sales. And I guess I'm going to need, let's just do a working capital schedule. Sometimes a little too stingy about whether things get schedules. Working cap. So first, days in year. This is going to be this minus this. Yeah, so we have 1 leap year in the mix. Then okay, so do I want to be very diligent? No, not really. Okay, so sales, COGS. Okay, in that case, I guess I will. Sales, COGS. They're already close by anyway. So sales is here, COGS is here. So this is sales, COGS. So it's going to be this divided by this multiplied by this. Lock that. And then we can lock this. Okay, so accounts receivable. Yes, it was 381. Hopefully it won't change massively. It doesn't change massively, no. and we're still in balance. That's good. Inventory. Well, yeah, again, we're growing, but it's not changing wildly. Prepaid expenses, again, growing, but not changing wildly. So that makes me feel pretty good about things. Not intangible assets, accounts payable. Well, it's 390, now it's 430. Yeah, that feels sensible. Okay. So that is working capital. Don't forget to adjust for leap year. Yes, I did. Thank you. Probably have a question on that. Projected amount of accounts receivable end of 25. AR 25 426.4. Good. Projected amount of accounts payable excluding taxes payable at the end of 29. That is here 555.3. Good. No, sorry, 555.3. Yes. Okay, so now on to the next thing, which is probably asset schedule. Yes, capex and depreciation, straight line depreciation. Existing fixed assets will depreciate over the next 7 years. Existing intangible assets amortize over 15. Assume no new intangible assets will be acquired during the 5-year forecast period. And then capex depreciated over 10 years. Okay, so what I'm noting right away is we've got 7 years, 15 years, 10 years. We've got a 5-year model, which means I'm not even going to think about that degree of flexibility because we're not flexing. So asset schedules. So existing PP and E. I'm going to want, sorry, put that over there. I want opening, depreciation, closing. So closing for 24 I can get from the balance sheet. That's here. Opening just carries some of those. And then I've got 10 years somewhere. Oh yeah, and I'm being bad about 7 years, sorry. Years. Let's call it life. So then I'm going to say minus this divided by this. Okay, and nothing's going to be negative, so I don't need to worry about that. And sorry, I have not been marking these off, so let's do this. Yellow, and then I'm going to use all of these now, so I'll just mark them all off. I've used the volume constraint, so that's fine. I've used all of these things. Yes, and that, good. Okay, just really want to make sure I don't miss anything. All right, so that's existing PP&E, existing, what do I call the other things, sorry? Intangible assets. Just call it existing IA, again, opening, amortization, closing. And life, again, will be 15, I think. Yes, that's the intangibles. They're all straight line. Good. So this one will point to here. And then just copy formula down here. And it's already doing the 15, so that's good. Then new PP&E. So we've got opening, capex, depreciation, and closing. So the closing is by definition 0 in 2024 because this is stuff that we buy after that. Opening, yeah, some of all that, copy across, fine. So capex, straight line, read all that. 250 million is capex each year, will be depreciated over 10 years. The acquisition of new assets happens evenly throughout the year. Depreciation will be on half. Fine. Capex numbers are given in real prices and as of 24, don't forget to apply cost inflation. Okay, so the capex then is where this times my cost inflation up here. That's good. It's a bit of a mess for all of those. Then my depreciation, again, I'm just going to link in my life here, which is 10 years, yes. Okay, so it's going to be minus sum of everything we've bought up to now, minus that over 2. That's our total capex with the half-yearly convention, divided by 10. Now I said because all the depreciation timelines are longer than the model timeline, I'm not worrying about. So I would need to, if this model were going to go out for 20 years, then I would need to make sure that this stopped depreciating at the end, this stopped depreciating at the end, and that after 10 years, this only looked back 10 years, but I don't need to worry about any of that stuff now. So, totals. So depreciation, amortization, capex. No, capex is already only one line. Amortization is actually also only one line, and PP&E. So my total depreciation is this and this. And my total PP&E is this and this. Okay. So now I'm going to put this in, and everything's going to start breaking, and that's okay. So that's my PP&E. I need to link in depreciation. And it's already got the right sign. And then I need to link in capex with a negative sign because capex is cash out the door. Okay, that's now balancing again. Asset dispositions. Disposition, no mention of that, so I'm assuming none. Okay, then capex intangible assets again, I think none. Is it somewhere here? No, it doesn't. Oh yeah, no new intangible assets. Fine. All right, so I do still need to link through the amortization and the intangibles. So let's do that. Amortization here equals this amortization. And that throws us out of balance again. That is welcome. And then we'll put it, oh yeah, that's right. I've linked that now, so that's okay to leave alone. This, yes, that's the right place. Now we're back in balance, right, because there's no cash impact there. So I don't need to do anything down here. So we're done with the asset schedule. Let's see what questions we can answer. The total nominal capex. Okay, that's a nice easy one. Make sure we're going in the right direction. 1367.1. Good. Total amortization expense in 25, 23.7. Total depreciation expense in 25, 367.98. Okay. 368.0 to one decimal place. Total book value of PP&E at the end of 2029 is here, 1901.2. No. Oh, crud. We're not that. Okay. Shoot. That's not good. Oh, yeah, sorry, I immediately see what I did. I didn't lock this. So the idea was that we'd sum all the previous years and then take half of the current year, but what we're actually doing with this very silly sum is just summing the previous year, the immediate previous year. So this has to be locked. And this is where those signpost questions come in, very helpful. So now 1743.6, good. Okay, what is the interest expense? Okay, so now we got to do debt. Let's go back over here. AFM has a senior loan with an outstanding balance of 600 million, 3% interest, 8 years of remaining repayment, equal principal repayments. Okay, so this is very simple. It's going to look exactly like these asset schedules. Debt schedule. I'm loving the automatic numbering here because I have not been bothering to update the numbers. So we've got senior debt. I think is it senior debt? Yes, senior loan. We've got subordinate debt, and we've got a revolver. Okay, so opening, payment, closing, interest. Same thing for the subordinate. And mostly the same thing for the revolver, which I'll mostly leave alone for now. Okay, so the senior debt closing in 24, we'll go get that from the balance sheet. Liabilities, long-term debt senior here, 600. And this guy is 200. How much did the revolver not shown at all? Okay, fine. So we're going to make that up, but fine. So and then this blah 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 blah. Here we are. Remaining repayment term and interest rate. So life, and for the interest, we'll say rate. That's 3%. This is the 8 years. And then we can mark those as used. Okay, so then again, this is going to be minus this divided by this. Happy days. Then what are we doing about the interest? Yes, average loan balance. So average of this and this times this. Okay, happy days. Then this will be mostly the same, except we'll do something different about the payments. And we have to give it a life. Well, figure out what we do about the life in a minute. Let's read about this. Subordinated debt. Variable interest of software plus 3%, 5 years of remaining payments, equal principal payment. Okay, fine. Expected to decline from 4.6 to 3.5, detailed provided in the assumptions tab. Fine. So where is software? Oh, there it is. Okay. Fine. So let's call this spread. And that will be 3% above software. Let's do software here. Don't want the spread in the middle of that. And then here we'll just XLOOKUP year of all of these in, actually, you know what, we can just do 2 rows. Let's not overcomplicate things. Okay. Then it's just going to be this plus this. Sorry. That's the rate. Yeah, let's just do I rate and I for the actual interest. And that's going to be average of these, which will break for now, but I'll fix it in a second, times this. And then this does just have a fixed payoff, so we'll add in life, link to that, which is here. And then we can mark all of these as used. Yeah. That all seems to be fine. That formatting is terrible, but that's also fine. Revolver, still need to work with. Again, it's going to start off at 0. Like that. That will link those and those, and then the interest. Let's see, do we have a fixed rate or a variable for the revolver? Revolving line of credit, maximum limit, and interest rate. Okay. Rate equals average of this and this times this. And then let's put in limit here. I haven't actually used it yet, but it is dealt with here. Okay, so we don't have an interest rate on cash balances. Fab. Does interest come in as a net? Yes, it does. Fine. Cash interest. Average balance. Indeed, the average of this year. Go down this year's closing cash here and last year's. And then interest. So again, we're just going to make this growth worst best active. So growth and worst both have 1%, base has 0%, active is 0%. Just put that into there. So rate this, and then it's just going to be this times this. Okay. So then net interest is going to be this plus we're going interest here plus interest here plus no, minus interest here. Okay. So let's link this in to our P&L with a minus sign. Then we want to have these things linked. So subordinated debt closing gets us out of balance, which is fine. Senior debt closing. Let's get us more out of balance, but that's also fine. Taxes are coming, but not yet. So variable debt repayment. Sorry, that's the variable is this one. Subordinate. It's senior. Those are still TBD, but we're back in balance. Okay. Definitely going slower, but I am being more intentional about it, which is what I wanted. So I guess that's okay. Okay, so let's see. Under the base case, cash balance is always positive. You need to model the revolver only to answer questions 24 and 25. Skip the revolver, still be able to count it. Fine. If AFM draws funds from revolver starting the following year, they plan to use all available cash to fully repay it as soon as they can. Yes. Principal repayments happen throughout the year, therefore you should calculate the interest. Yes, fine. You just switch on iterative calculations. Yes. Okay. Wait, hang on. Where's the interest and cash balance? Okay, here. Average cash balance for the year will bring interest income of 1% of both the growth and worth. So you'd need the iterative turned on anyway, but okay, fine. So I think we're done with debt. Let's move on. Preferred equity and dividends. In order to secure funds for extraordinary dividends of 2026, 100 million of preferred equity in the middle of 2026. Okay, so let's have some equity schedules here. Equity schedule. Preferred. Opening, issuance, closing. Don't think there's any question of buyback. So, I guess we have none to start. So let's just preferred shares. Okay. Then our issuance in 26 is, so where are we? Dividend, preferred stock, here we are. Preferred stock issuance Y2. That is a terrible way to put it. Fine. Since I'm being picky, issuance year 2026. Just please. Okay. If let's do this. Amount year. And interest, which I will need a rate. And then I can mark this section as done. Okay. So if year of this equals this, then this, otherwise 0. And then we'll sum. Okay, and then it's going to be the average of this and this times this. Okie doke. Sorry, that's not interest, that's dividend. Fine. So then, common dividends, so I also need to have okay, whatever, I don't care. So pref issuance, pref dividend. So this is going to link to this. And okay, one thing at a time. And let's have our preferred shares be this plus the minus the issuance, wherever the heck I just put that here. All right, no, it is plus. It is plus. Yeah, we're issuing, so we're getting cash. We're also increasing our preferred shares. Happy days. Then preferred dividend is going to be minus this. And that's going to go up to our dividends. No, we don't have that here, so we'll just take it out of retained earnings. because the bit that goes, oops, sorry, copy over. Okay. So then, what are we doing? Anything with common? 10% yield, mid to, yes, fine. Oops, sorry, got the pen out. Common equity, no changes expected. Every year, distribute 50% of its net income available to common shareholders. Net income remaining after distributing dividends is fine. Recently announced on 26th they'll pay an extraordinary dividend of 1 billion in addition to the regular dividend for on the last day of the year. Fine. Okay, so common div. So first we'll say net income, which I don't actually have working yet because I need taxes, but I'll just take it anyway. Then we want NI to common. It's going to be this minus this. Then target dist. It's going to be this times 50%. Extra dist. And again, we'll have amount in year. And we need to put in a year here as well. And that is also 26, I think, pretty sure. Blah, 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 yes, 26, fine. Extra year. All right, so that will link to here. This will link to here. And then this one should probably just be the same as this one. Okay. So then the common dividend is going to be the sum of those two, which is just this plus this. Okay. So common dividend should come out of click. What's going on? Here we are. Shares. So this does not change. Common share issuance buyback does not change. And this. Ooh, it's getting a lot bigger. That's probably because we haven't done taxes yet. Fine. Then retained earnings, we're going to subtract that. Oh, no. Don't subtract the entire thing, just one, please. Okay, we're back in balance. Hooray. So that is that. Taxes, 20% of EBT. Special reduction of EBT for tax purposes. Assume every year this amounts to 100 million. It doesn't change with inflation. Lower the amount of tax they need to pay. The difference should be added to the deferred tax liability. The taxes paid in the next year as a result of current year's taxes will be shown in the balance sheet under current liabilities section. Okay. So let's do a quick tax schedule. Tax schedule. So EBT from over here. EBIT, profit before tax. Of course, they'd give it a different name. Oops, sorry. And copy over. So then, I guess the question is, does this ever go negative in any of the scenario? It would be worst if it does. And the answer is not even close. So that's good. Don't need to worry about edge cases and zeros and weird stuff. So accounting tax, which is going to be this, oops, sorry, this times 20%. EBT edge, going to be this minus, oops, minus this, oh, plus that, all right. Then gov tax, book tax, I can't even remember what it's called, but it's going to be that times that same 20%. Okay, so then my deferred tax is going to be this minus this. 20 million seems like a lot. What's going on with? I've been 5 up to now. That's punchy. No, fine. Okay, so current taxes. Current tax. Well, it's that one. So now, let's put this in carefully. That keeps us in balance. Yeah, that makes sense. Then the tax payable is going to be this year's government tax. Yes. Oops, sorry. Huh? Why is that still spilling? Huh? Oh. Ah, shit, because I've got circularities on. Oh, bugger. Well, that's very bad. Okay. I'm going to have to break my circularity. So let's just... That should break the circularity, yes. Okay, be careful when you have circularities on. Anyway, sorry. So this should just be... It's freezing again. Slightly worried that I'm going too slowly now, but I think it's okay. Okay, now why is that not throwing me out of balance? Where is tax down here? Add back deferred income taxes. Yeah. Deferred tax there. Puts me out of balance, but that's fine because I just need to add it to my deferred tax here. Where are we here? Gets me back in balance. I feel like I'm missing something. I don't know. All right, well, anyway. Okay, so I think we're done with taxes. Let's go answer some questions. Question 15, interest expense for the variable rate subordinated debt in 2029. Interest, subordinated debt. Probably answer these as they come up, but anyway, never mind. 1.86. 1.9. Fine. Total interest expense. Net, presumably. Well, it doesn't matter because there wasn't any. So 112.13. 112.1. Yes, fine. Total amount of preferred dividends is going to be 35. Fine. Current tax for 25, but they'll pay in 26. 69.93, 69.9, yes. The amount of deferred income tax for 25, 20. AFM's retained earnings at the end of 29 after paying the ordinary dividends. Okay, this is a moment of truth. 1210.4. No, shit. Ugh. Okay, so this is pretty much where I got to on the live solve. I've kind of wound back the final model I made to here. The one thing I'll just mention is I did add in the base growth and worst scenarios for the SOFR rate because I hadn't done that at that point. But aside from that, I think this is mostly as it was. So, so I couldn't get the closing retained earnings to match, and then there was a later question on, I think, closing cash, which I couldn't get to match, and then all the scenario questions, nothing matched. And so everything had worked right up until the end, and so I was sure that the problem had to be somewhere in the last couple of things I had done, the equity schedule and the tax schedule. As you can see, I'd grabbed the answers and tried to see, okay, how different was I from each of these? No obvious patterns there. It didn't bloody help at all. Sometimes it helps. Spent ages poring over, especially these two, because all the answers up to there had checked out. So if you had a sharp eye, you will have spotted that as I linked things into here, sometimes I just did one link and copied across. Sometimes I did a dynamic array. I guess I still haven't completely decided which of those is my go-to. But in one case, which was the interest expense, I did a copy paste special link. And somehow I didn't know I use it occasionally, but I guess not in this kind of situation, that pastes an absolute reference. I added a minus sign, but I missed that there was a dollar sign on it. So I copied it across and had the same interest expense in every year. And I answered whatever interest expense questions I had from the debt schedule, where everything was working fine, but over here it wasn't, and that threw everything out of whack. So at I think 1 hour 50 minutes, pretty much exactly, I realized what had happened, deleted that, copied across. Suddenly, everything worked. So I got my total retained earnings answer. I got my total closing cash answer. Got added this bit in and then quickly got the scenario answers. So the only other bit to show you was adding in the revolver, which I had not yet done at this stage. So let's do that. There is a circularity in the model already, so you could, I guess, just be extra circular, but I'm going to try and be a little more proper than that. So I'm going to add in the long-term liabilities section, a revolver, and that's obviously 0 for all the historical periods, and then we'll do something with it in a minute for the future. And then down here, we're going to need revolver issuance repayment, which again will be 0 for all the historical periods, and then we'll have to add something in. And then what I want to work out is cash flow pre-revolver. Sorry, cash pre-revolver, not cash flow. And so that I can grab it from the cash flow statement is going to be my opening cash plus my cash flow from operations plus my cash flow from investment plus all the cash flow from financing changes that are not the revolver. And so this is the cash available. So if this goes negative, then I need to draw on the revolver. If this is positive, I can use it to pay off the revolver. So in this case, we're not given a revolver limit, so I can just say equals minus the min of the revolver balance and the cash available. So in other words, if the cash goes negative, we'll draw that in the revolver, and then we'll use whatever cash we have to pay off the revolver up until it's fully paid off. And the formatting here is horrible, but never mind. But now let's use the real formula there. So in the base case scenario, we don't use the revolver, which is fine. The interest is already linked through, so we just need to link the draw, which I was about to copy and paste link, but I guess hopefully I've learned my lesson there. Apparently I haven't. So that links the issuance and repayment, and then the balance links to here, to the closing, and then hopefully that keeps us all tied up, and then we can go to the worst case scenario and hopefully find, yes, these are ugly as well, that we are drawing on the revolver and then repaying. I ended up getting, so there were 2 questions about the worst case, which is the max revolver draw here, and then maybe closing retained earnings or something. I ended up managing to get this question wrong because I hadn't fully done the connection into the balance sheet when I did here. So I think this ended up being like off by a few $100,000, which was disappointing because I kind of had the things working, but the challenge was I spent so long. I spent like probably half an hour trying to debug this model, and then literally with 10 minutes to go, found out what was wrong and kind of scrambled to finish it all off in 2 minutes, as I've now done here rather more casually in about twice that time. I still managed to get the time bonus, so I guess that's the main thing. Anyway, that's all I got for today. Thanks for watching. See you next time.